Hello, everyone. Welcome to the Catalyst Funding September 2023 Real Estate Market Update. We're glad to be back with you and bring you the latest numbers from Houston, San Antonio, Dallas, and Austin, as well as a look at the latest and greatest on the real estate market for investors. I want to introduce our founder and CEO of Catalyst Funding, Wade Comeaux.
Hello, everybody.
And we've got our Director of Lending, Jeff Johnson.
Howdy.
And our special guest this month for the September 2023 update, we have with Benchmark Insurance Group of Texas, we have Haitham Foty.
Glad to be here. Hello, everyone.
We love partnering with Benchmark, and I'll let Wade give a little bit of an introduction on Haitham.
Sure. Well, first of all, the first thing I would say is that Haitham currently manages the insurance for my portfolio. So I'm definitely a believer, and I think I've been working with them for maybe 9 years now. So it's definitely a great relationship. And they are in the real estate investment game. They have a construction company. They're active investors themselves, and they bring that perspective, that understanding and experience to helping you best take advantage of the real estate investment products. And they have a lot of unique products. I mean, they understand going from acquisition through rehab, through vacancy to getting a property leased. If you're doing a buy and hold, you can add properties and pull them back. And whenever I went through the major flooding event with Harvey, they were really on it, ensuring that my claims were processed very quickly. So I'm a loyalist to these guys. I don't necessarily get as excited about everybody I speak with because I'm not necessarily already working with their products, but I think Javar and Haitham do an excellent job over at Benchmark, and I strongly encourage them. So that's my intro to Haitham. Other than being a really good guy, he also runs a great company.
Thank you so much, man. I really, really do appreciate it. I appreciate the continued business and support. And that's sort of our job, right? Just to find simplified ways for our investors to make the insurance process easier for everyone. And as we know, we're in a market, the most volatile insurance market that we've ever been in. So it's only becoming harder. And however you can save time, money, to simplify that, I think it is the best way to succeed in that area. And so, yeah, definitely appreciate it. And we try to offer, all different types of products for our investors, from single family, multifamily, you name it, and really try to educate our clients as well. And then the claims consulting thing, we want to guide you through that process, because that is the only thing that sets us apart from our competitors, is how are we going to deliver for our clients in a claim. And most agencies that I'm aware of don't tend to go above and beyond. They hand you a number and say good luck, and we take a more hands-on approach. So certainly nice to hear that.
For sure. I do have a question before we dive into the presentation. I know it is a very volatile and changing insurance market. Do you have a couple of tidbits or important things that investors should know about the changes in the insurance market?
Absolutely. You need to check the company ratings. We're also in a time now where a lot of the company ratings are moving from A to a B, or B to a C, due to poor claims handling. So that's the first thing you want to do, is know the type of insurance company that you're dealing with. Secondly, you want to dive a little deeper into the policy documents to know, do I have a replacement cost policy, or do I have an actual cash value policy? Is my property going to be declared as brand new, or are they going to depreciate everything if I have a claim? So, for investors who are buying a lot of dwelling fire properties, you personally want a DP3. You want to make sure that if you're doing rehab to these properties, that your builder's risk policy has water coverage. I'm seeing a lot of foundation leaks and things of that sort really arising these days. So, there's a lot to really look to, and ultimately you do your research, right? You want to find an agent who can really educate you on the policy that you're receiving, and then from there, make sure you're in good hands. And I think, I just think a lot of carriers and a lot of companies now are getting away from the service aspect of the business. So it's up to us to really educate you on what you have or don't have. But dive into your exclusions. Look at your exclusions and it will paint the picture for you. So it's not what is my insurance covering, it's what is my insurance company not covering. It's the biggest thing.
Great advice.
Well, I'll offer this disclaimer and then we'll dive into this month's real estate market update. I know a lot of people rely on this each month, and we feature different snippets from our market updates in our social media reels. So be sure and follow us on social media, stay up to date with the latest and greatest. And just a quick disclaimer that this presentation today is for general information only. No information, documents, or estimates presented here represent any financial determination on investment performance. Basically, Catalysts, our guests, our agents, representatives cannot be held responsible for any decisions you make based upon what you hear today, but we do hope it benefits you greatly. That being said, we'll dive into this month's market update. I'll be back at the end for anybody that leaves questions in the chat feature here inside of our webinar, as well as to announce the winner of our drawing for half off your hard money processing fee. Enjoy the webinar.
Thank you, Derek. I'll go ahead and cover this, if that's all right. So for those of you that aren't familiar with Catalyst and what we do, this is just a quick slide, a few bullet points on the things that we specialize in. We consider ourselves a one-stop shop for hard money and permanent financing. So if you're a real estate investor, whether you want to do flips, rentals, etc., we have you covered. All of our loan officers are licensed, so they can take you on any product you want, from hard money all the way to the conventional refi. We've been involved in thousands of transactions. We're a lender built by real estate investors. So as Wade said earlier, he's an investor. We've done investing before we even did lending. So we really focus on helping our real estate investing community have the financing to get their deals done. So hard money, conventional, non-conventional, we'll touch on this. Everybody knows what a conventional loan is. Not everybody knows what a non-conventional or DSCR loan is. For you folks that are self-employed, or a couple other reasons why you do a non-conventional loan. If you've been turned down by a conventional lender, give us a call, talk to one of our loan officers. We might have some options for you so you can either get into or stay into the real estate investment game. Next slide, please.
All right. So diving into Houston, this is where our company Catalyst is based, also where Benchmark is based. I think we'll have some good insight here. But one of the more interesting things that I noticed is that while the volume is off of last year's pace, which was like a historic pace, right? It's still up from the pre-COVID level. The August 2019, 3.1 billion there, and then we have 3.6 right now, so still up from that pace. The total sales are down overall, but because of the much higher average sales price from that time frame, the overall volume is up. So if you look at that home price trajectory from August 2019, average sales price being 312, we're up 36.9% since then. The median price up 36% since then. And then another interesting point is the months of inventory. While not as fast as the torrid pace from August 2022, it's still significantly faster market than August of 2019. So while we really anticipated, rates having an impact, a severe impact, many of us anticipated, it has had an impact for sure. But for what was really a normalized market back in 2019 for the Houston area, we're still a faster market, lower days on market. So despite the fact rates are higher, because there's such little inventory, it's still a strong overall market without any real price reduction since that time. So it's really an amazing story because of the lack of inventory.
Yeah, I saw the lower numbers, and like you said, interest rates are affecting everything, plus insurance possibly. So it's just getting more and more expensive to buy a house. But you're right. If you look at the sales are down, but if you look at the months of inventory, it is lower than 19, and the days on market is lower than 19. So that tells me that despite the recent negative trend, things are still very good, relatively speaking. especially 4 years ago.
I think people are more reluctant to jump into a higher interest rate when they have a lower interest rate. Maybe that's why there's a little less inventory.
That's 100%. Yeah, 100%. That's it. Like this, if you have a 3% mortgage and you know that even if you want to upgrade to a bigger house, you're moving on to, you know, you're going to give up that 3 and you're going to pick up a 7, right? And so that's just a lot more expensive on your monthly payment. So people are very reluctant to get rid of it. I saw a stat that said, I think it's up it's up from 15 to 20. I don't know if that's monthly or annually, but the percentage of overall sales as new home versus resale is up to 20%. So 20% of all sales, I think it was a nationwide stat, are new homes. So that is really that's a big number and it's growing.
I thought it was even higher than that from our presentation last month. I could be wrong, but I thought it was significantly higher than that. But
I might go find the article. Yeah, it's up.
Yeah, and I think that if you think about why people buy new homes, right? There's relocations, maybe new jobs, moving to a new area, be closer to family or some other reason. And then there are level ups. You know, people go from a certain home, they want to get a bigger home, they have an extra child, or they're doing well financially, they want to upgrade, whatever the case is. But the upgrade piece is almost non-existent at the moment because it's very, very difficult to do, right? In order to, if you're going to finance your home, in order to get into a more expensive property with the higher rates, your payment is just going to go up exponentially. So that's very difficult. But we have some other things going on, right? People are moving to Texas. A lot of people are still moving to the state because it's so much more attractive. The job market is very strong. So when you see these sales that took place last month, that's going to be the large majority of it, is something outside of just leveling up the property in which people live.
I did see this real quick. I read a stat on HAR. Although it is the, I think, 17th month in a row it's been a decline, it is the slowest rate of decline yet. So like the decline in sales, it's obviously slowing, but it's this was the first month that it was, or the best month it's had since it's been a minute, but 17 months in a row is the rate of decline was the smallest since last spring. So I guess things are starting to thaw up a little bit.
I mean, and we say falling off, but it's more so just, you know, meddling off a little bit, but
yeah,
probably due to the time because people are back in school and it'll probably pick back up into the year, into next year, right?
Yes, I typically, I would definitely agree with that. Let's dive into Dallas on the next slide. Do you guys do a lot of business up in Dallas, Haitham?
We do. We have a lot of portfolios out there. We do a lot of multifamily. They are more at risk of hailstorms than anything. We have the hurricanes here in Houston and Dallas. It's all hail. And, you know, to that point, insurance companies are putting little exclusions on roofs for roofs that are over 15 years old. So be aware of that as well. But we do quite a bit of business out there.
That's interesting. Because Wade, I know you talk for investor purposes, if you can, you know, correct me if I'm wrong, but like if a lot of strategy on roofs is if you have an older roof but it's functional, when you're rehabbing a property, especially for a rental, you can keep it there because you're probably going to get a hailstorm and you're going to get some damp. You're going to be able to get a nice claim and get a new roof on it. But if they're putting exclusions on those now, that you might have to rethink that practice.
Well, if it's over 15 years, then yes. Even if you got a roof that's 20 years old, there's going to be a discount based on the age of the roof, even if it's not in Dallas, even if it's in Houston. So there are some factors there. But one of the interesting things is, you know, the deductible that you choose, right? Whether, you know, some people might do 5,000, some people might do more or less, but a lot of different categories, you got to do the math on it. Sometimes it doesn't make sense to make a claim unless it's a big enough claim. And the roofs are typically very big, and oftentimes the insurance will pay out a much larger amount than we as investors are required to pay, right? That's one of the things about being an investor is that if you can't find lower cost materials and labor, then then you're really missing the boat. But that is one of the areas where the claims typically do make sense. A lot of the other smaller claims, like I choose to have a little bit larger deductible to get a better monthly price. A lot of times they just don't make sense. So unless you have like a flood or a roof claim or something else major, oftentimes your insurance is just there for the major emergencies, not for the small, first and second base issues that you might have.
That's a great point, Wade. The insurance companies pay out $400 to $450 per square. So 100 square pieces of roof, they pay out $400 to $450 per square. You can get it replaced. If you know a roofing company, if you know a contractor that can do it, you can probably get it replaced for about $200 to $250. So there's definitely a spread there where even though you have a higher deductible, you can compensate that difference with the amount that they pay on roofs, which is probably the one benefit to insurance companies, is that they pay so much for roofs.
Yeah. And I think the average consumer not very possibly, probably is going to pay that amount, right? Because the delta between what the average consumer pays who, finds somebody off of Angie's List and what we find working with roofers that are in the business and marketing themselves at industry events is just a huge difference. So,
right.
All right. So Dallas, Jeff, why don't you run with Dallas?
Sure. So if you look at total active listings, they are up relative to last year. They are down relative to 4 years ago. The sales slightly down 8%. Not a big jump at all. Similar to Houston. Houston's down 8% as well. So prices, the average price is actually higher than what it was a year ago. 61% higher from 4 years ago. Same thing with the median. It's slightly down 2%, but nothing crazy. So when you hear about all of the negativity with interest rates and the slowdown, it really doesn't seem to be affecting Dallas that much, to be honest with you. I mean, an 8% drop in transactions, okay, fine. But if you look at the months of inventory, 2.7, that's less inventory than we had 4 years ago, which people would consider a completely normal market. So I think it's positive. Like Dallas has been very resilient during this whole high rate thing, and their prices are strong. Like they have been one of the top markets in the country, certainly in the state. It's a great place right now.
Yeah, I would add to that. If you look at the pre-COVID increase, 60%. No other markets above 40 in these 4 major metros that we're going to cover today. And that's one of the strongest numbers in the country, but 60% is really an amazing number. And then 2.6 even year over year with rates being what they are. And, sometimes I hear people talk about, well, sales, total transactions are down. As a real estate investor, that does not affect you at all, right? How does average transactions being down adversely impact you for the properties that you own and that you're renting out? It really doesn't. What it does do is it means that your rental market is stronger. And if you're flipping a property, it's stronger because there's just scarcity. So that's why you're able to get really strong prices despite rates being higher, because there's so much scarcity, both on available rental properties and on, of course, flip properties. And if you're doing a really high quality flip product in this market, especially in a place like Dallas, where there's so little inventory compared to August of 2019, like that, the total inventory is down significantly from that 2019 number. So I think Dallas in particular is an excellent flip market for sure. And where we're seeing investors find properties for buy and hold is definitely farther out. With that high of a price point, average price, 514,000, median 406, it can be difficult to make the numbers work, very difficult to make the numbers work on a cash flowing rental. But we're seeing a lot of people go closer to that Oklahoma border, a little bit further out, and they're getting really, really good deals in a market with an outstanding job market and a lot of stability.
Yeah, I was going to ask you, Haitham, if you guys pick up new clients in Dallas, are the majority of their properties in Dallas, or are they more spread out?
It's more spread. Yeah, it's more across the board. Less in actual Dallas, more Fort Worth area. Just further on the outskirts that we're seeing a lot more deals, especially on the investor side. like you're saying, a lot of the older 1970, 80, 90 homes are being purchased and rehabbed and either flipped or leased. But yeah, not so much in Dallas per se, but as a whole, it's still pretty frequent and busy.
Yeah, and there are so many major businesses and corporate headquarters moving to Dallas right now. The numbers, every week I see a major company moving down there. It's really pretty incredible. They've built a great ecosystem with low tax approach and a lot of incentives to bring these corporate headquarters from other areas that are struggling, high tax states, states with other issues. They're really crushing it right now, bringing in those corporate headquarters to Dallas.
The permitting out there sucks though.
Yeah.
The permitting sucks in Dallas.
No, yeah. When trying to get anything approved by, out in McKinney or Dallas, it's very stringent, and they do not let anything fly like they do in Harris County.
Do you think so I was going to ask you, so does it suck relative to other places or just in general, you think? Because like I know places like on the coast, it's a nightmare, but you're saying you're comparing it to say like Houston.
Okay, or compared to Houston, because Houston's so large, right?
Yeah.
Out in McKinney, I mean, they are very particular, and also it's just very slow. So what the turnaround time that you would get in Harris County of 3 weeks to a month will take anywhere between 2 to 4 months out there, which I've just heard some real nightmare stories about project delays just from permitting alone.
Wow, that's interesting. I think I'm guessing Jeff is right in that, whenever you're comparing to Houston, it's probably a lot more difficult, but compared to New York or California, it's probably a lot more approachable because
Right.
like 2 to 4 months sounds bad, but I do remember, and I don't know if it's still the case, but a few months back, there are actually more building permits in, I think Houston and Dallas than in all of California combined, which was the next closest state.
Yeah.
Texas
Correct.
was just crushing every other state, the total number of permits, including Florida, which was a bit surprising that we were so much ahead of Florida as well for new home permits. But the numbers are pretty big.
It wasn't even just total permits, it was permits per person too.
Yes.
So it's not like Texas is a big place, so there's a lot of people here, but you're still crushing everybody in permits per person. That tells you something. Or there's little states with maybe a few people. You would think that they would be at the top, but no, Texas was number one in volume and per citizen, I guess.
Yeah, per citizen, I think it was literally double the next closest one, which was maybe California, which we were all a little bit surprised by.
I'm surprised with that, but yeah.
Are you guys seeing more out-of-state investors coming along, from California, from up north? I see a lot of it on my end.
Yeah, we get. Yeah, I thought you were asking about properties. No, but the investors, yes. Like a lot of folks from the West Coast, Washington, Hawaii, California, a lot of Arizona. Like a lot of our investors are coming from the western part of the country.
Same.
Yeah.
So they have a lot of affluence and money to invest, but being in the single family or multifamily space, there's a huge barrier to entry with cost, and our homes are just so much more approachable. I mean, we're talking about Dallas and saying it's difficult to have a cash flowing deal if the property's worth $500K, and in many parts, those areas, you can't find a home for $500K, right? So it's very, even what you lose in investing remotely, you pick up by just the opportunities being such a superior price point.
Yeah, I mean, I don't know who it was we're talking to. It was a little while ago on one of these things, but just talking about how markets price themselves out of the single family rental space. Like you get to a point where you just cannot own a rental on a single family at least and cash flow, just because the math never works out. We're lucky in that the majority of our real estate here in Texas, on the average, is still rental. Try like Wade said, try to go to Arizona or Seattle and try to do that. It's not going to work.
Yep. Let's dive into San Antonio. Which San Antonio, if you look since pre-COVID, has actually grown more than Houston on the average sales price, a little bit less on the median sales price, definitely far below Dallas in the groups we've covered thus far. But the months of inventory is slightly above where it was August 2019. So I'd say of the 3 markets we've covered thus far, San Antonio is one of them where it's a little bit down on sales price both in the average and the median, and the months of inventory and the days on market are higher than August of 2019. So I would say it's a little bit softer market than you're going to have in Houston, significantly softer than you're going to have in Dallas. But whenever we're talking softer, as we know, 6 months of inventory is where it switches from a seller's market to a buyer's market. Still not anywhere close to that, and I really don't see that happening in San Antonio. But if you're comparing between these 3 different markets we've covered, a little bit softer both in price and in months of inventory and just speed of the market in general down in San Antonio, but still very attractive price point, and we see a lot of investors getting great rentals in that San Antonio area.
Yeah, I agree. Of the 3 that we've covered so far, it is definitely feeling the effects the most. I do, which makes, I get it, but I do, there was a few webinars back, there was a study that said San Antonio was like the #1 market in the country for real estate investors. And so I don't think these numbers show that. I think they were thinking more long-term. Just look at price relative to the city and what it has to offer. Because it was more of a, I guess, a blue collar town, I think. So it's a great rental spot. It just hasn't got there quite yet.
And the insurance in San Antonio was about 30 to 40% less than Houston.
Less.
So that it would make these deals look a little more favorable, from a profit and loss standpoint. I think, they're not exposed to what Dallas and San Antonio is as much as we are. And just the average homes out there, relatively, 2,500 to 4,000, especially for the investor side. And it's cheap. Homeowners here, the average homeowner's insurance rate is roughly $2,200 here. And that's for a 2,000 square foot home. And they're paying anywhere between $700 to $900.
Wow.
Yeah.
Wait, 2,200 versus 900?
Correct.
Get out of here.
Yeah, that's for newer homes. Newer homes, it's a lot less.
That's amazing. That's a game
significant.
changer.
That like takes a deal from cash flowing or not, or vice versa. Like,
Right.
That'll make you buy a deal versus not buying a deal.
Absolutely.
If those numbers are that much lower. Wow, I did not realize that.
And it's funny you say that. We're losing more deals now due to insurance than ever. Where
sure.
Just the numbers do not make sense for these investors to buy, whether it's due to the floodplains and the cost of flood insurance and the increasing rates of property rates. We're losing a ton of deals just based on insurance alone. So
I got a question for you.
Yeah,
go ahead. Yeah.
You mentioned flood, and I'm curious because a lot of investors will they'll do a deal as a rental. If you find out it's in a flood zone, that could possibly just crush your cash flow.
Right.
So my question is this: how many deals do you if somebody were to get an elevation cert, once they go through that process, is it typical to where the cost of the flood diminishes significantly, or no?
So that's a loaded question because I've seen it affect the client, right? Where I'm like, hey, go get the certificate, and it should bring the rate down. Should. That's based on the flood elevation, the base flood plains, it caused the rate to jack up $2,000, right? So it's not going to be as significant as it was 5 years ago. So if the flood insurance is around, $1,800 to $2,500, and you get an elevation certificate, it may shed about $300, $400, $500, on the better side, but it's not going to make a significant dent to where, let's order the elevation. And I've seen in situations where, they provide the elevation cert and it caused the rate to go up substantially. So if you can get away with finding a flood policy, finding a good balance of coverage and deductible, and making the price, favorable, then try to go without the elevation cert, because the elevation cert process costs anywhere between $300 to $700 to do a survey. So you got to factor that cost in as well.
That's interesting because now when you say $2,000 for a flood policy, that makes sense. I'm thinking more of the really expensive ones that I've seen, like the houses down in Bel Air or the Westbury area where the flood insurance can be outrageous.
Right.
That's more the scenario I was thinking. If it's $2,000, yeah, that's real money, but like it's not the end of the world. Like I've seen some of the like $8,000.
Right, right. Out in Ireland and the areas that have flooded back to back over the last 7-8 years. Yeah, those flood policies are out ridiculous, 7 to 8 grand.
Even with an elevation cert on something like that, because that might be worth it. Yeah.
It would. You may save a couple grand, but at the end, they want those properties elevated, right? And the state was actually, they had a fund to elevate a lot of those properties in Ireland and other areas that were taking floods 2-3 times back to back. And so it's not a matter of if, it's when. So even if you get the elevation cert, they're not giving you that much. I've seen a $2,000 price break, a $3,000 price break in some situations. But now the insurance companies are very aware of which areas are high risk zones, and it's just not worth it to them. So now they're in a place where this is our rate. If you like it, great. If you don't, great. And there's not much wiggle room in between these days.
Interesting.
Good to know.
Let's dive into Austin.
California.
So Austin, active listings are up 10%. Sales are flat, really. I mean, 0.5%. It's not that big of a deal one way or the other. Down slightly from 4 years ago, where say San Antonio and Dallas and Houston were all up slightly. So, oh no, I'm sorry, that's the same. Median price of 460. That -7%. That's a comparable hit to San Antonio. I would have thought it was more, to be honest, because Austin had such a big run up. But a 7% reduction so far. Median inventory. Median sales price. Months of inventory 3.8. Again, compared to San Antonio 3.9, Dallas 2.7, Houston 3.2. So not as high as San Antonio's, but higher than the other two. And days on market 60. That is the longest days on market. But still, I mean, if you look at Austin as a pre-COVID investment 4 years ago, you're up 40%, which is still pretty sporty.
Yeah, the median sales price up in Dallas 406, Austin 460. So Dallas is really narrowing that gap. There was a time when like Austin was significantly more expensive than any of the other 4 major metros, but with the current trend, there's a real chance Dallas gets within striking range of taking over that number.
The gap. So the gap last year was 85 grand. This year it's like 50 or 50. The gap was 80, now it's 55. So it's gaining on it.
For sure.
And what I'm seeing in Austin are quite a few investors that are doing a lot of new construction on some single family, and they're building these duplex type properties, and the prices that they're getting on them. I mean, you think 4,000 square feet and they're selling it for upwards of $950 to $1 million, but it's 2 units. They're selling each unit independently, and or they'll sell it as an investment package. I'm seeing a lot more new construction, sort of like the townhome, the townhome binge that we had here in Houston, or in the Heights. They're building out there, and the numbers that I'm seeing in terms of what they're selling for are outrageous.
Yeah. All right, let's I think this next slide is a slide that we were all excited to cover. The data source smart asset, and it's a very recent article from September, and it looked at the top 400 metro areas and home price changes from 1998 to 2022. Overall, home prices have grown an average of 150%, which tells you that even if you don't pick the perfect market, that's still a very strong growth rate over that time frame. Plus, you get all the major advantages of owning real estate. So when you're comparing rates of return to like the stock market, that's not a fair comparison because you get so many other things. You're not just getting home price appreciation versus stock price appreciation. You're getting monthly cash flow. You're getting tax advantages, right? You're getting depreciation. You're getting all these other game changers whenever you're comparing asset investment classes that are so strong. But whenever we dive into the numbers, Texas is all over this thing. Of the top 20, I don't know, what am I seeing here? 12 stars? Like it's
Yeah.
really, really dominant. So Austin Round Rock, #1 overall in the country, 253%. The next closest, 255%. So literally 100% more growth than the next highest rank. That's an incredible number. You know, just an incredible number. But then #2 is Midland, Texas. You have some Colorado areas there. And then you come down, Odessa, Plano, San Antonio, Houston. So the 4 major metros from Texas, all in the top 10, right? 4 major metros all in the top 10. Then you got Waco, you got Fort Worth, College Station, Denison, Abilene. So really an incredible story for the state of Texas in general. But that delta between #1 and #2 is pretty amazing.
Yep. This is 25 years ago, so you think, okay, well, it's been a good run. But if you look at the last chart we have at the end is always the affordability index. There's still plenty of markets in Texas that are affordable. Like Austin is the highest ranked at 21st. But Houston's 38, Fort Worth 48. So there's still opportunity to grab real estate in Texas and it be a good investment. You think, okay, well, 25 years, if you start it from today, it's going to be way too expensive. But it's really not.
No, I mean, I think to your point, Jeff, you're really comparing to other cities with comparable amenities. You think about what cities have comparable amenities to a Houston or a Dallas or an Austin, and certainly to a certain extent San Antonio too. And you're talking about maybe 15 cities that you could really throw into that mix. And then these 4 Texas markets are exponentially more affordable than all those places. The Los Angeles, the San Francisco, the New York Cities, the Bostons, the Miamis, significantly less expensive. So that's why there's so much runway still to go for these 4 major metros.
Yep.
Anything to add to this one, Haitham? Anything that jumps out?
It is just amazing to see the growth over the last 25 years. I mean, that's I mean, do we see that go? I mean, where does it go from here? I mean, I guess that remains to be seen. But if you got into real estate early on, I mean, now it's just what you've made on these properties is exponential. So yeah, definitely still a great time to buy and be active.
Next slide, please.
Sorry, I'm having some technical difficulties over here on my end, but I can cover this. So Haitham, if anybody doubted, Haitham knows what he's talking about. The #1 multifamily market is Austin, right? New construction, so the top 5 cities that have the highest number of new unit permits issued per 1,000 residents, Austin's #1, 18.3. Then there's Raleigh, Jacksonville, Orlando, and Houston right there, #5. So to your point, Austin and Houston is trying to play catch up and build some apartments, right? Do you guys insure apartments as well?
That's one of our specialties. I do a ton of multifamily, and also one of the hardest insurance markets is in multifamily right now, especially for coastal properties. There's limited capacity to go around in Houston or in Texas for that matter. So, 10, 15 years ago, I can take a 1970 frame, 80 unit apartment complex and have, substantial coverage. Now, these insurance companies are putting loss limits where they're saying, hey, we'll cover this property for 10 million, but wind and hail, you're only getting $1 million. So they're putting loss limits on everything because they just don't have enough capacity to go around, amongst all these properties. So it's and on top of that, the prices are 150% higher than they were 5 years ago. So it's making those deals less favorable. And to my point that we're losing a lot of deals, a lot of my multifamily deals are being lost because of insurance and the cost of insurance. What they paid last year is completely obsolete. This year is a whole new beast, and there's just not enough coverage to go around. So if you're going to get into that space, find something fairly new, 1985 or newer. Make sure that the circuit breakers are not Federal Pacific. Make sure your wiring is not aluminum wiring. These are all the things that insurance companies do not want to see. If your roof is 15 years or older, they don't want it. So you have to include that in your CapEx charges, right? To figure out, hey, I'm going to take this, C-class apartment complex, and I'm going to, turn it into a B. I'm going to replace this, that, the roof being one of them, the AC units being the other. Otherwise, you're just not going to find an insurance policy that gives you enough coverage at a decent price. Sorry to drop the ball.
No, it's great info. I think a lot of our people are really passionate about that, so great info. Let's go to the next slide, please. So as we mentioned earlier, there's not a lot of people leveling up, but there are a lot of people relocating. And so this is really a cool chart. This includes zip codes only, right? So the hottest zip codes where people are relocating. Once again, Texas is all over the list. Leander, Cypress, look, the home of Jeff Johnson himself, is like one of the hottest 10 zip codes in the country. I'm not sure if it's because of Jeff or Jeff just happens to be there.
I mean, it's not a coincidence. It's about when I moved there.
Then we got Forney, New Braunfels, Katy, another Houston market. So really all over the list is the state of Texas for most popular zip codes. So, and that's why I think we're more resilient than a lot of other places. People are moving here, which means you're giving up your 3% because you got a new job. You're giving up your 3% because you're moving closer to family. So it's more manageable. You're not just moving to a bigger house in the same neighborhood, which doesn't make economic sense at the moment, right? People just can't do that anymore.
Yep.
Next slide. So, yeah, we're getting a lot of news on this, Haitham. So we wanted you to talk about, some groups moving out of Florida for insurance, a lot moving out of California as well. Give us your take on that.
Yeah, and you can go ahead and add Texas into this. A lot of the carriers that have taken a beating over the last 10 years are pulling out of these coastal territories, right? Especially Florida. I think State Farm, Allstate has pulled out of Florida. Farmers has pulled out of California. Between the wildfires and the things they deal with out there, it's no longer profitable for these carriers to just, pay out billions of dollars after every disaster. So, they're losing rating, right? These A plus carriers are now going to A- or a B. Or I've had 4 carriers this year completely shut down doors, right? And not just shut down saying, hey, we don't want new business. We went bankrupt, we're out. And these are A-rated carriers. And then you got to factor in the freeze that we had. The freeze paid out, I believe, upwards of $14 billion, where we were never exposed to freezes here. So, yeah, we're just in a very rough time of insurance where there's just not enough capacity to go around. And now your big names, your State Farms and Farmers, Allstates, are also pulling out from a home insurance standpoint. So where they used to be the go-to and they had 80% market share in the nation, they're just backing out and allowing these independent companies come in and really take on a lot of that exposure. But as we know, being in coastal territories just hasn't been profitable for these carriers. So it's what we're seeing now, and it's only going to get worse.
I read the article, and the one interesting thing it was obviously the claims, but the other thing they cited was the fact the cost to rebuild. So if you have a claim, you have to rebuild, and that's gotten a lot more expensive.
That's a little skewed, though, right?
You're not buying that one?
No. It's true what they're doing, right? They're forcing insureds to have more coverage, right? Which also increases your property rate. So what would have cost $200,000 to build 3 years ago, they're saying cost $300,000. And yeah, there's some validity to that. But there's also, what are the chances for me having a total loss, right? Why do I need to insure this? If I paid 150,000 for this property, why do I need to insure it for 350, right? And that's just the constant battle between the carriers. So yes, they are forcing the insureds to have more coverage because they're saying the cost of labor, taxes, and materials is greater, and replacement cost is much higher than what it was 4 years ago. So with that, aside from the property rate going up, your amount of coverage is increased, which increases your deductible, right? So you're paying more for insurance, your deductible's higher, and when I need insurance, I have far less coverage than I anticipated. So it seems like a lose-lose situation for us.
It's definitely a unique challenge that wasn't as high on the radar as it was whenever I first got into the investment game back in 2012. Something you got to think about.
Yeah.
Let's go to this next slide here, and we may skip a few, but I think this other one is something valuable to see. Both the national market and the Texas market starting in 2000. This is like the level set, and you look at the growth over time from that point and how significantly greater it is in the state of Texas. And, Haitham mentioned earlier, where do we go from here? I think this chart just keeps moving in that direction. We're in a low tax state, great economy, tons of businesses moving here. So I think this trajectory goes in the same direction. This next slide, I'm just going to skip this one in the effort of time because we're approaching the end. The employment index, anything jumping out at you on this one, Jeff? Next.
No, I read the A&M report. It's just basically it's an indicator of the health of the economy, and it was all good news. I mean, we've been talking about it. Companies moving here. There's plenty of jobs. It's a measure of, I think it's a measure of wages and unemployment and new hires. So, relative to the rest of the country, Texas is doing great. It's not any more complicated than that right now. We've been talking about it for a while. Just all the conditions are right for good economic growth and employment.
Next slide. So Haitham, you were talking a little bit about the permitting process, which is obviously huge if you're doing new construction. I'm interested to your insights on this chart. Kind of covers Texas as a whole and then focuses on the two biggest metros in the state. You see anything here jumps out?
Houston and Woodlands at the bottom.
Mm-hmm.
Yeah.
No, not particularly.
A little bit of the same info we looked on the other slides. I mean, I guess at the end of the day, it's really just looking at the growth rates versus the other areas. One thing that does jump out to me a little bit is just Dallas and how much that the housing starts are higher than Houston even. That's an interesting variance between the two over time.
This next chart's pretty cool. If you go to the next one, it's seasonally adjusted rent rates, right? So what does it cost to rent a property in the markets? And the part that I thought was interesting was San Antonio is significantly lower. Now, obviously the prices are lower, not by that much. So that's what I'm saying. I think there's room to rise for San Antonio rentals. But Austin and Dallas are pretty much the same, which I thought was interesting because I would assumed Austin would be higher a little bit than Dallas. So that just tells me that you can still get some cash flowing. It's easier to get cash flowing properties in Dallas than it is in Austin, simply because the rent relative to the price the value of the real estate is higher.
I guess what's the differential? Like how many more homes are being purchased through your company out of Dallas versus, let's say Houston or Katy in those areas? Are you getting more deals out there these days, or?
We're getting a lot of the deals in the outskirts, like north, basically anywhere between Dallas and Oklahoma.
Sherman, Dennis,
yeah.
In those areas. Got it.
Yeah, a lot of activity. I mean, we're still doing our fair share of Houston's. Don't get me wrong, but But that area is really productive right now.
One last thing before we move on from this chart I thought was interesting is that you look in 2015 and Houston is neck and neck with Austin, and then actually slightly above Dallas. Then in this 2016, 2017 range, you start to see Austin and Dallas pull apart on average rents, which I think from a real estate investor perspective, the average incomes in Houston are not exponentially lower than those other places, but the rents are a little bit more attractive. So they may have some upside there. In San Antonio, I think whenever we go and look at the affordability index and the average income, I think you'll see some real opportunity to just point in San Antonio. That may have the most upside on potential future rents of any of the markets that we're talking about today.
Do you think we have more inventory in Houston than we do in Dallas?
Of rentals?
Yeah, rental properties.
Man, I would have to look at that data. My guess is that there are more.
Yeah, I would assume that could factor in why we're a lot lower. We just have a lot more inventory to go around, but I could be wrong.
That makes a lot of sense to me because more investors see deals that they can rent. It's just harder to find a single family rental viable property up in Dallas, certainly in Austin. So this next slide is the 4-week rolling average of the median sales price of homes sold, right?
Yep.
You can see 2023, and this is on a month-to-month basis, which is nice to bring in the seasonal, because seasonality, last year there wasn't as much seasonality, but seasonality is a real thing, right? There are always fewer homes sold in the winter. So we can see the year-over-year numbers are on a pretty strong year-over-year trajectory, in all honesty.
Look at I find interesting. Look at 22. So you look at 20, 21, and 23. They kind of have the same path trajectory, and then 2022 is fine until you get to August, and it just takes a nosedive relative to the other two.
But yeah, you compare the numbers this year. Whenever you compare it to last year, it wasn't as strong until recently. But man, look at it in comparison to 2020 and 2021. Vastly superior, even though rates are a lot higher right now, right?
Yep, that was free money back then still.
Yep. So that's a good point. Next, on the next slide, going over the rates where we are today.
Yeah, you can see, I think it's pretty much more the same, yeah? Or where you want to cover this one?
No, I think we're good here. I'm sorry.
Okay.
I just wanted to go to the next slide. Yep.
Yep, there we go.
So you look at the rate, today 7.59. That's a higher rate than we've had in some time. But you go back to 2000, everything 2000 before the great financial crisis, this rate is in line or lower to anything that we had in the previous 40 years. So just bringing a little bit of context to the rates. It is, I think right now, comparison is the problem, because like Jeff said earlier, Haitham said earlier, if I have a 2.75, I'm comparing to a 7.5. That's a very difficult decision. But historically, these rates are pretty reasonable. But once we kind of work through and people eventually have to make moves, because people for jobs and other things eventually do have to make moves, we'll kind of start to see fewer and fewer of these super low rates. And then I think we'll get a little bit more normalized, people being willing to level up over time. Going from a 7 to a 7 is not that big of a deal. Going from a 2.75 to a 7 is a big deal.
Yeah, I mean, even if it's not the mental part, it's just the dollars. It's just,
yes,
people can't afford
it. Next slide. Jeff, what are your thoughts on this one?
So these are the projections from Fannie, Wells, and the MBA for interest rates starting Q3 of 23. They all think they're going to go down. Some more than others, 6.75 to 6, 6.75 to call it 5.6, and then 6.75 all the way down to 5. What I thought was interesting, because I read the article and all of them had predicted lower interest rates this year and had to alter their predictions. So I think they're guessing. I think the article I read that said rates are going to be higher and longer than people want or hoped. And we listened to a podcast, and they've been preaching that for a while. The rates aren't going anywhere anytime soon. As long as inflation is high, they're going to go down eventually. To what degree and what speed, I don't know, and I don't think they know. To be totally honest with you, I just know that it's going to be taking more of a normalizing of just the mentality and the mindset of rates being at that level for things to get back to relatively normal.
I am of the opinion if we get into the fives, we'll see a nice mini refi boom for people in our space. So, once you get like a 1% delta, 1.5% delta, the economics work out for people to go and refi all these transactions. And if you look at the number of transactions, especially in Texas, they've not been significantly lower than that 2019 number. They just haven't been. So there's going to be a nice refi boom if we get down to that level. When that happens, it's eventually going to happen without question. Do we see 2.75s again? Maybe not. Do we see 5.5%? I'm completely confident. That's just a matter of when and not if. I think we're definitely going to see that again. So this next slide is just on housing starts over time. We talked about this a lot. Why is there such a lack of inventory? You see, going back into the 1960s, what happened from 2010 to 2015 was unprecedented. Never that few of homes built, and still really haven't recovered to where we were, prior to the great financial crisis. Back in the late 80s, 90s. You have periods in the 70s. Even in the 60s, when the population was less than half that it is today, people were building more homes. So it's just a huge lack of inventory relative to population. And this next slide really shows that, going back to, if we can go to the next slide, going back to the population level of 250 million back in, early 90s versus today, 33 million, something like that. And you can just see the number of homes built relative to population. It's an amazing statistic. And even with people say, man, are we building too many homes right now? That's definitely a no, because we're not anywhere close to catching up. And that's why, despite drastically higher interest rates, we're still seeing strong home prices, especially in Texas. Anything else jump out on this chart?
No, not for me. We've been covering it. It's a lot of the reason why we are in the shortage we're in.
Yep.
Next slide. Here we go. So rental vacancy, I'll cover briefly if you guys have comments. As you can see from the peak of, I guess, 2010, down to now, and it's starting to creep back up. Not a lot of vacancy in the 70s. So what do you guys think about rates and how that's going to affect this chart and the ability to rent these properties out?
Not sure that I fully, Haitham, did you fully grasp that question?
How are the insurance rates going to affect the?
No, interest rates. So the interest rates.
Interest rates, I apologize. What I meant.
Rental vacancies. Yeah, if you could tell the people.
I would assume that, I know that the home builders are building more homes, right? I would assume that the cost of the interest rates would prevent people from buying more and more apartment complexes being built and less homes being rented out, maybe, though I may be wrong.
Yeah, I think what we've seen thus far is that, in my opinion, homes were being, the average price being paid in the state of Texas was very, very high because rates were so low, right? As a percentage of the after repairs value, we reached levels that were unprecedented. People were paying 92.5%, 95% of the after repairs value on a home they still had to repair. Right? We would see those deals, a large majority above 85%, 87.5%, 90%. We've seen those numbers pull back as rates have increased. But at the end of the day, if a distressed seller wants to sell their property, whenever I first got into the business, we were told never pay above 70%, right? And we were getting a lot of deals at that point, at that level. Distressed home sellers have been a little bit spoiled and able to get a lot higher prices. But I do think that there are still homes being sold because those distressed sellers don't have to get 92.5% for it to make sense. So what I think is happening is the market is normalizing and cooling down. And what investors are looking at now is I'm getting great equity capture. They're not as fixated on trying to get home run cash flows, because you're not going to get home run cash flows at the moment. But you can come back and refi that deal because you got that great equity capture, and your ROI at the moment is really strong because you're paying less money out of pocket to buy the property, and will be a massive increase when we do eventually get those lower rates and your cash flow goes from 200 to 300 or 400, because it'll make that big of a difference if you get 1.5–1% lower on the interest rate. It's going to be a huge boon for the people who are the savvy investors that are willing to look at the equity capture of the moment and not get overly concerned about the lack of cash flow, because that's a momentary thing. That's not a permanent.
Good information. Are you guys seeing an uptick in short-term rentals as well?
You know,
Not really.
the rates being where they are,
I'm not-
that's been tough. That's a little bit tougher market at the moment, I think. I don't know what you see. I know you have I don't know if she is still in it, but I think your wife may have been involved in the short-term industry.
Yeah, she manages.
So give us an update on what you're seeing. You have more info than we do.
On that end, it's Airbnb is shutting down in a few states right now, where homeowners associations just aren't allowing short-term rentals. So they're making it harder for that business. It came in hot, pre-COVID, and there was some serious ROI there, but as of late, it's plummeted. So I'm seeing a lot less on the short-term side than I am, and I'm seeing a lot of my Airbnb investors completely switching to long-term leases now as well.
There's not as many loan products either, to be totally frank. Like the
Yeah.
short-term mentioned. There are products, but there's just not that many.
Right.
Let's do this last slide, and I think we may have a few questions. I'm sorry we're at 102. I want to be respectful of everybody's time. Real quick, we try to provide some context on this affordability index. When you look at certain cities like, Dallas as an example, where their trend has been. Dallas was in 2019. This is really the least affordable markets for the major markets. So Dallas, which has huge amenities and everything, was 19th least affordable back in 2019. Then it became the 32nd least affordable in 2022, and now it is up to 23, right? So that's kind of the trend there. And then you have, Houston. You can see the trend. August 2022 is the 38th least affordable, and still the 38th. So whenever you think about, whenever I was talking earlier, you're thinking about job market, you're thinking about amenities, you're thinking about quality of lifestyle, you're thinking about access to restaurants, entertainment, things of that sort. And the cities in that 38 number, or where San Antonio is, even more attractive than that, they just don't have the type of amenities that you're comparing to. You really should be comparing Dallas and Houston to the Miamis, Los Angeles, New Yorks of the world. And it's just exponentially more attractive. So when we're talking about where we go from here, I think that's a big reason to be optimistic, is that it's so much more affordable than these other markets. And this is just baking in home price, right? Typically in some of those other markets, because of taxes and other things, gas is more expensive. Definitely have state income taxes. So
Water.
beyond just this, you got a lot of reasons that people are moving to Texas. You're about to say something, Haitham? I apologize.
No, I was alluding to your point, saying, water has gone up, electricity has gone up, and everything has just taken a hike.
Yep. All right. I think we did some good. We're a little bit over, but want to see if we have any questions. Derek, do we have any questions today?
We do. We have a couple of questions. So the first one is, based on what you said about the Dallas prices, how should that impact your choices as a real estate investor?
I think flipping is a very good market there in Dallas because the low days on market. Tough to find deals for single family, one door in Dallas, although if you can find duplexes to quadplexes, those numbers can work. And then going further outside of the major metro, we see a lot of high quality rentals there. To Jeff's point, going up towards the Oklahoma border, even into Oklahoma. Some people are commuting from in Oklahoma into the north side of Dallas because a lot of the jobs are up in that McKinney, Allen, a lot of the, Frisco area. So that's not an unreasonable commute hell, people in Houston and San Antonio and Austin are making a longer commute than that, and it's within the state. So people don't get overly focused on the border there as much as how long it takes them to get to their job.
All right. Well, question number 2, in the top 20 lists, it mentioned Midland, Waco, some other smaller markets. What would be the pros and cons compared to your Dallas, your Houston, your larger metro areas as an investor?
I can give you my opinion. I would say the pros are there's less investors. It's a little bit cheaper. So you're going to probably find better deals. So you're not going to have to pay up to get the properties. Your equity capture should be greater. The downside is just logistics. I would say getting GCs out there, and I don't know how many GCs go out to the outskirts of Midland, or service providers, the foreclosure process, stuff like that. Like, well, that's for us for lending, but like just maybe eviction process. It's just things are going to take a little bit longer, I guess, in those types of markets. You're going to have a harder time finding service providers. Would be my guess.
Great point.
Yeah, I see a lot of people doing it though. I mean, do they have contractors in Midland? Absolutely. It's a little bit difficult to isolate them because, to Jeff's point, whenever you're operating in a city like one of the major metros, you can go to these industry events, or if you join a membership organization like Benchmark, and we sponsor like Lifestyles Unlimited or Total Wealth Academy, you have access to these contractors and other things. It makes it a lot easier. But are there people who work with investors in a city like Midland that are contractors? Absolutely. It's just more difficult to find on the desk point. It takes longer to get an appraisal sometimes. It takes longer to get other services because we may not have as good of contacts with appraisers out there or something like that. But the deals that people get are great deals. Like, we see deals out there that they're buying at 75% after appraised value, maybe even less. You just don't see a lot of that, inside the major metros. So I would not go out there and buy a comparably priced deal. You should be getting a discount. If you're getting a great discount, then the complexities and the challenges can be overcome because you're getting such a discount.
Plus, you have upside too. You never know which one of those markets is going to really take off.
For sure. All right. Well, I think it's a good point to wrap up here. So, Derek, do we have a winner for today?
We have a winner of the half off your first hard money loan processing fee. Omar Cabrera is our winner this month. Omar Cabrera.
Congratulations, Omar.
Props.
So I think we wrap up. We're a little bit over. Haitham, excellent job today as usual. Thank you for your support. And great job, Jeff and Derek.
Definitely. Thank everyone for watching the 2023 September real estate market update. We'll see you again next month, and be sure to catch us at one of our real estate mixers if you're in one of the markets that we're coming to. So just like they say on College Game Day, we're coming to your city. So we'll definitely be there soon. Look forward to meeting everyone. Thank you for joining this month's market update. Thank you, Wade. Thank you, Jeff. Thank you, Haitham, for being our special guest.
Appreciate you, Haitham.